Okay, why don't we start then? So last class we talked about the present value formula. We talked about different kinds of assets and how I can use the present value formula to relate different payment streams to an annualized interest rate that we could then use to compare what is or isn't a better way of borrowing, right? It would be hard to compare, let's say, a 2-year bond and a 5-year bond, or a 2-year loan and a 5-year fixed payment loan. And being able to use the present value formula to compute these yields to maturity at an annualized rate makes them comparable, at least to some extent. Now, one of the things that I mentioned yesterday, however, is that, not yesterday, last class. One of the things that came up last class is that yield to maturity is only useful if we're thinking about an asset that we're going to hold until maturity. If we're planning to sell it before, then what we actually get out of holding that asset is a bit different. It's the rate of return. So we talked about that definition. And another thing that I mentioned was that I think towards the end, that depending on the maturity, a different kind of assets that's otherwise the same might be exposed to more risk or more uncertainty depending on the maturity. So one thing I wanted to do today was to go over that and show you a numerical example of how your rate of return might depend on, well, on uncertainty, but also on what kind of asset you're holding. Then I want to go back and look at something that we talked about, which was that at least from money, the rate of return on money is related to the inflation rate, right? If you hold money but there's inflation, then what you can buy with that money changes. And I wanted to do something similar to think about other assets, not just money. And finally, I don't think we'll have time to finish this topic, but I'd like to also talk about how it is that prices are determined in equilibrium, so to speak. So in micro, when you were taking micro classes, the price of a thing is determined by the forces of supply and demand. We've talked about how to figure out the relationships between prices and interest rates, but we haven't discussed what are the factors, the economic factors that affect supply and demand for assets. And so I'd like to do a bit of that as well, although we may not finish. So if no one has any questions or comments about what we did last week, then you can go straight into the whiteboard. So let's start by reminding ourselves of the present value formula. This is for one payment after m years. We have this. The interest rate is related to the price of the asset in this fashion. And remember, we wanted to talk about how assets with different maturities might be sensitive to uncertainty or to risk. So to do that, if you want to look at an example, we need to have an example where we look at several different bonds that are the same in all ways, except for the maturity. Now also, the key here was that we're not planning to hold them until maturity, right? If you hold something until maturity, you know exactly what's the relationship between price and interest. It's this. So the second element of our example is that we plan to hold each of these otherwise similar bonds for only 1 year. So they may have maturity 1, 5, or 20. Doesn't matter. You want to look at what happens to them if we sell them after 1 year. And let's say that the bonds in question have a future payment of 1,000. And the company that's selling these bonds has other alternative ways of borrowing. What we need is a benchmark such that bonds like this are expected to yield 10%. So there's this 10% benchmark against which all the prices are being computed. The lenders could buy similar bonds that yield 10% from other companies, and the borrowers could borrow 10% maybe from a bank or from some other source. And the other element that we need is that there could be some uncertainty about events. And in particular, there's going to be uncertainty about future interest rates. What we're going to do in our experiment is look at two things, because we know that people in this environment expect interest rates to be 10% now and in the future. So our experiment will ask two questions. One is, what happens if expectations are correct? And second, what happens if expectations turn out to be incorrect? So let's go to a different software. What I want to do is I want to try and draw a little table with all this information using software called Excel. Now, some of you may know how to use Excel. If you don't, I will do my best to walk you through this. So for starts, we have that. Okay, I think I want to zoom in a bit. So just give me a second. Zoom in like this. So let's just remind ourselves, the people believe the interest rate is going to be 10%. Forever. There may be some uncertainty one way or the other, but that's the expectation. And F is 1,000. All right. Now I wanted to look at what might happen to bonds of different maturities. So let's just write some possible maturities here. 1, 2, let's say 5, 10, 20. So there are these 5 assets, and they pay you $1,000 after this period of time. And the first question we're going to want to know the answer to is, how much would each of these be worth based on everyone's belief that interest rates are going to be 10% forever? Well, all we need to do to figure this out is apply the present value formula. So the value of the 1-year bond, this should be easy, is just the $1,000 that we're promised divided by 1 plus I. Now, I is 10%, so that's 0.1. to the power of the maturity, which is 1, so we don't need to do anything. What about the 2-year bond? The 2-year bond pays you 1,000 in 2 years, so we have to discount that. You're at 1 plus the interest rates, which is 0.1. But we have to put it to the power of this maturity, which in this case is 2. So one thing I could do is I could just write the number 2. But in Excel, you can do another thing, which is you can hold down Control and set and click on this. And now it knows, okay, it's to the power of 2, because that's the number that's in this box, and that's the maturity. Naturally, the price is lower because we have to wait longer before we get the payments. What about 5? We could do the same thing as before, 1,000 over 1 plus the interest rate, which is 10%, to the power of, again, I could write 5, but it's more convenient, again, to just hold down in Excel, Control, I click here, and now it knows that the value of that box, which is 5, is what I want there. That's useful because if I copy this formula and paste it below, it's going to, this is the wonder of Excel, it knows that it has to look to the left to figure out what's the power. So here I get 1,000 divided by 1 plus the interest rate to the power 10. It already knows that it's supposed to look to the left and read that, and so it already puts it to the power 10. And same there. So now I have the price at 10%, assuming that interest rates on these kinds of things will be 10% at different maturities, just using the present value formula. But remember, the key part of this exercise is that I am planning to sell all these bonds after 1 year. And since I'm planning to sell them after 1 year, that means there's another thing that I need to know, which is the price next year of these bonds. Now, I'm assuming that the interest rate will be 10% forever. So what we're going to figure out then is the price of these bonds, assuming that I'm correct, and 10% remains the interest rate on similar things going forward. So let's start with the 1-year bond. It was a promise of $1,000 in 1 year. Now a year has passed, so what is it worth? Well, now it's a promise of $1,000 now. $1,000 now is worth $1,000. So that one is straightforward. What about this one? This one was a 2-year bond, so it was a promise to pay me $1,000 in 2 years. A year has passed, right? So this is now a promise of $1,000 in 1 year. There's still 1 year left on this contract, right? So I could do 2 things. One, I could say just to the power of 1, which of course is 1.1. But another thing I could do is instead say, well, actually, it's to the power of this maturity over here, but 1 year has passed, so actually there's only 1 year maturity left, so it's that to the -1. There. What about the 5-year bond? Well, a year has passed, so once a year has passed, it's just a 4-year bond. Again, I can use 0.1 to the power of, I can just write 4 there. Again, this is Excel, so I could equally well write that it's to this power over here, -1, because again, 1 year has passed. They're only 5 minus 1 or 4 years left. The advantage of doing it that way is because then I can copy this and paste it here, and you can see it's updated. It knows that it's supposed to look to the left to figure out what's the power here. So it's 1,000 discounted, not 10 times, but 10 minus 1 times, or 9 times, which is exactly what we want. 1 year has passed, there are 9 years left, and I can do the same for the 20-year bond. 19 years are still left. Okay, so those are the two inputs we needed to figure out the thing that I ultimately care about, which is what is the rate of return if my assumption was right and I remained 10% forever. Now, just a quick refresher, the rate of return is the coupon rates plus the capital gains rates. The coupon rate is any coupon divided by the price for which I bought the bond. The capital gains rates is the price at which I sold the bond minus the price at which I bought it, right? Any increase in the price between me buying it and selling it contributes to my return, scaled by the price at which I bought it. So my rate of return in this case is pretty straightforward because there's no coupon, right? This has an F payments. These are zero bonds. There's no coupon rate. I picked that so that our life would be easy, so we know the rate of return equals the capital gains rates. This is the price at which I bought the bond initially, and this is the price at which I sold it a year later. So we have the inputs we need to figure out the rate of return, if everything was correct. So again, using Excel, I can say this is the price bought, sorry, the price sold, minus how much it cost me in the first place. If there was an increase between price bought and price sold, then I made a gain. Scaled by, again, the price when I bought it, which is the initial size of my investments. And I get 0.1 or 10%. You can actually click here and it'll show it as a percent there. What about the next one? Well, I could do the same thing, or again, I could just copy this formula, Control C, and paste it, Control V here, and it knows to look at these two numbers and treat them the same way. So it's going to take the price sold, you can see there, it's the price sold minus the price bought divided by the price bought, using these numbers instead. And I can do the same thing with these, and you see that actually they're all 10%. So we had a constant expectation of what would happen. If everything works out, turns out the rate of return and the yield to maturity are actually the same. Oops. So far so good. What we need to do now, however, is look at what happens if things didn't work out as we expected. So what if the year passed? It turns out that after a year, beliefs have changed. There was some new information that entered the world that we didn't have at the beginning. And let's say specifically, and now we all expect interest rates going forward to be 15%. What do we need now? Now, well, the price bought is the price bought. We already bought it with the belief that prices were going to be that interest rates are going to be 15% going forward. This change in information or in beliefs, however, does affect the price at which we sell it. Because everyone else knows that interest rates going forward, or believes that interest rates going forward will be 15%. So we need the price next year if I equals 15% forever. How do we do that? Well, let's start with the 1 year maturity thing. The 1 year maturity thing, you bought at this, a year has passed, and now it's a promise of $1,000 today. And $1,000 today is worth $1,000. Nothing has changed. The future interest rates don't matter because this is no longer a loan contract. Its maturity is complete. So that's just 1,000. Nothing happens. What about the 2 year bond? The 2 year bond, however, is still it still has a year outstanding, right? So the 2 year bond is now a promise of $1,000, sorry, 1 year from now, but at the interest rate of 15%. So as before, rather than entering 1, actually that's okay, we could enter 1. It's fine. Because there's 1 year left. Or as we put it before, it's this maturity here minus 1, which is 1. With a higher interest rate, this bond is not worth as much as it would have been with the earlier belief of 10%. Similarly, this 5 year bond is now a 4 year bond, right? So 1 point with an interest rate of 15 going forward, I can write it to the power of 4 because there are 4 years left. Or I can do this to the power of 5 minus 1. And then again, I can use that formula down here. I could do it manually, or I could just paste in the formula so that we could see over there that, again, with the higher interest rates going forward, the prices of these things have gone down. The next thing to do, finally, is compute the rate of return. If the interest rate is 15% forever. And again, how do we do that? It's the price sold, brackets, price sold minus the price at which I bought the thing, divided by the price at which I bought it. Let's make these percents. Same here. This is the price at which I sold it minus the price at which I bought it, divided by the price at which I bought it. And you'll see now the 1 year bond was not sensitive to this change in beliefs because I was holding it essentially to maturity. But the 2 year bond, now suddenly you see if the beliefs of the interest rates rose, the value of this, the remaining value of this asset is now diminished. The present value of what's left of this asset is lower, and my rate of return will only be 5%. Remember, I can copy this and paste it, and it will apply the same formula for the longer term assets. And again, you can see the longer the maturity, the worse the rate of return in this case. So these longer term bonds have rates of return, if you're not planning to hold them to maturity, they have rates of return that are much more sensitive to changes in interest rates in the environment. Now, this is not saying that the problem is that the long-term bonds are exposed more to bad things happening. I mean, they are. But they're also more exposed to good things happening. To see that, let's say that, suppose that a year passed, when we bought the bonds, we thought interest rates would be 10% forever. It turns out that after a year, beliefs have changed. Now we expect interest rates going forward to be, let's say, 5%. Well, the interest rate is 5%, then what's happening going forward is that things are discounted less heavily, so they may actually be worth more. So the 1-year bond, well, it's still a 1-year bond because, sorry, the 1-year bond, a year has passed, so now it's transformed into a promise right now of $1,000, so it's just $1,000 like before. The 2-year bond is a 1-year bond, except the interest rate now we change from 15% to 5%. And we can do that with all the others, change the interest rate from 15 to 5. So the 0.15 becomes 0.015. And we see that now the long run bonds are actually exposed to better things happening as well. If things work out better than you anticipated, in this case, if interest rates drop, then you actually make a gain with the long-term bonds that you wouldn't with a shorter-term bond. But the point is not about gains and losses. The point is about randomness and volatility or uncertainty. The rate of return on these longer-term bonds is much more uncertain than the rate of return on the short ones. Any new information that might come in particular, that it might affect interest rates, makes their long-term bond, the rate of return on long-term bonds, jump or collapse. They're much more sensitive to that than short-term bonds. And that is the point. Any questions or comments about this table before I turn back to the whiteboard to discuss this? So far, so good. The key, I guess, to this is the notion of what's called, well, key to this is the idea that in general, people don't like risk. So this is a concept you may have come across in another class, but you may not have. And actually, maybe I should get out of here. It's the following. Consider a situation where you have to choose between experiencing risk and not experiencing risk. So imagine that I have 2 envelopes in my hands. In my left hand, I have an envelope that has $1,000. In my right hand, I have another envelope. Before class started, I flipped a coin. If it came up heads, I put $2,000 in this envelope. If I got tails, the envelope is empty. And I say to you, which envelope would you like to choose? The one with $1,000 for sure, or the one with a 50-50 chance of getting 2,000 or nothing? So if you ask this to a large number of people, almost everyone chooses the $1,000 for sure. In other words, we view uncertainty or risk as being a bad thing, as being costly. So that idea that people in general tend not to like risk and would tend to prefer a sure thing than a lottery that gives you the same amount is a concept of risk aversion. And people's behavior seems to display evidence that we are risk averse. We rather avoid uncertainty and risk if possible, as opposed to an entity that doesn't care. Like imagine a different kind of being that actually doesn't care which envelope it takes. It views an average of 1,000 and 1,000 for sure as being the same thing. We call that risk neutrality. So person who doesn't care about risk. behaves as though they don't care about risk is called risk neutral. Yeah. So that's an important thing to keep in mind. So what we just saw is that long-term assets, so assets with high M, ultimately are riskier, because any change in the information in the world makes their prices fluctuate more. And the particular kind of risk that we looked at, right, it was about fluctuations in alternative interest rates. That is known as interest rates risk, because economists are so original at coming up with names. So interest rate risk is going to be something that's going to appear over and over throughout this course, because it turns out that interest rate risk is something to which most economic agents are actually exposed to. The reason is that when consider any company, any large company that generates profits throughout the years. Let's say it's a car company. They're selling cars, so they generate cash flows. Very often the companies, well, one of their options with all the money that they just made is to just have it sitting in a bank account somewhere. But if it's money sitting in a bank account, it's probably earning little or no interest. So what large companies sometimes do is instead they use this money to buy bonds or other assets. And that means they're exposed to interest rate risk. They're supposed to be a car company, but they also have these financial risks that they expose themselves to. Ultimately as a choice, because just holding cash when you don't have anything to do with it right now isn't as good maybe as buying some asset with it. So interest rate risk is something that many companies experience and have to deal with. So any questions or comments about this? We've applied the present value formula to several assets, figured out what it tells us they must be worth after a year, even if their maturity is longer, and seeing that long-term assets are riskier because of interest rate risk. Let's see, someone has a comment. Sorry, Meher, you raise your hand. Go ahead.
Hi, could you go back to the Excel sheet really quick, because I wanted to see the change between the 5% and 15 again.
Sure, I can show you quickly. There. So this should have said 5, I guess, at this point, because we changed all the numbers. So what happens is that I guess, I'm not sure I can use P. Whoops, sorry, I made a mistake. Present value formula is that P is equal to F over, I'm not sure I'm going to be able to do this. I'll try. 1 plus I, and I'm not sure if I'm going to be able to write the M here. No, not working. So I'll just use the usual power symbol. Mm-hmm. That's the present value formula. Now, when we get here, we only have 1 year left. So that M there isn't 2, it's 1. It isn't 5, it's 4, and so on. But since the interest rate on alternative assets has gone, in this case, down, the denominator is smaller, it means this whole thing must have gone up.
Yes, okay.
Yeah, and this to the power of M means that if M is larger, then that's compounded, and so this has gone up by that much more, let's say. When I was 15, of course, it's the opposite, right? This number is larger than 10%. So when I goes up, the value of this whole thing goes down, and If m is a larger power, then it goes down by more.
Got it. Yep. Thank you.
Sure. So either way, whether interest rates rise or fall, the impact on the rate of return on the longer bond is much larger. So the whole thing is riskier. I will upload an Excel sheet of this kind. I think I may have already done so into Blackboard under lectures. So if you want to play around with it and try different interest rates, you're welcome to. All right. So the next thing I wanted to look at seems a bit different, but I guess it's connected to something that we talked about last week, which was that the remember that I said that the return, I guess the connection is that we're still trying to talk about returns, as though we've also introduced a new issue of risk. Last week we were talking about money, and we were saying that the return to money is minus the inflation rate. Because if I have some money and prices rise, what I can buy with that money has gone down. So I wanted to be a bit more precise about that, since we talked about it last time, and also make the observation that this inflation issue isn't just one that affects money. It actually affects any contract that you might sign that involves money. In other words, any nominal asset. If I borrow $100 from you and pay you back 110, that's 10% interest in terms of money. But if prices rose between you lending me and me paying you back, you're not actually getting 10% back extra in terms of stuff. Right? To the extent that there is inflation, you'll actually have less. So the interest rates that we've been discussing that's in terms of how much extra money you get, right? Again, you give me 100, I give you 110, the difference is 10, we divide it by the 100 you gave me, you get 10%.
Professor, can you share the screen?
I'm sorry?
Can you share the screen? Thank you.
Good. Sorry about that. So the return on money is negative the inflation rate. That was what I was saying earlier. And then the interest rates you've been discussing so far are in terms of how much extra money you're getting back. So you give me 100, I pay you 110, the difference is 10, 10 over 100 is 10%. That is called the nominal interest rates. So anything nominal means it's only in terms of cash. Another way of thinking about it is that it's not being adjusted for inflation. You may remember this from nominal GDP in your macro class. What if we instead adjust for inflation? Adjust for the fact that the money I pay you back may not buy you as much stuff as the money you gave me. When we do that, again, you may recall this from your macro class, what you get is something else called the real interest rates. Something that's real in economics means that it's being adjusted for inflation. And it's defined, we can define it easily as the nominal rates minus the inflation rates. So if I pay you back, if I pay you 10% interest, but inflation has been 10%, and effectively what I'm paying you back is the same as what I borrowed. You can buy the same amount of stuff with that money as otherwise. Now, we're not going to care about real rates always. Like if we're trying to compare what happens to one nominal asset versus another, let's say one bond versus another bond, they're both affected equally by the inflation rate. So then we don't care too much. The only time we're going to care is if we're comparing a financial asset to some other kind of assets that isn't affected by the inflation rates. What kind of asset might not be affected by the inflation rates? Well, actually, how about the house that I'm in? That's a thing that I live in. It lasts for a long time. Its value rises with, well, it has a price. So when there's inflation, its price might rise with inflation. Whereas the value of money and all other financial assets erodes with inflation. So anything like that is not a financial asset. It's called a real asset. And it could include any object that you could buy that you could then sell again later, just like a bond, and it would still retain some of its value. It could be a house, it could be any other durable as long as they don't deteriorate very much, like a car, and furniture. When I was in Peru growing up, there was a year when we had 7,800% inflation one year. You can imagine. It was a mess. It meant that holding money was kind of pointless. I mean, you'd buy something, but then as soon as you had it, you had to run out and try. If you got money, you would run out and try and buy something with it so that it hadn't lost value too quickly. And one way people dealt with this was by buying foreign currency, which wasn't experiencing the inflation. But another way is that we would run and buy out real assets. And for example, when I was there, one of the unusual things that turned out to be used as real assets was that people were buying nicely carved leather furniture. Why that? Well, first, because it's durable, right, if you're careful with it. Second, they're quite beautiful, beautifully carved leather. And third, we have a lot of tourists. And one of the things they liked to buy and take home with them was beautiful leather furniture. So they're actually fairly liquid. So people were hoarding sometimes leather furniture as a real asset because inflation was extremely high, and they were fairly liquid because we had enough tourists. So keep in mind the real interest rates. It's going to come up on and off whenever we have to think about what's happening in the nominal world versus the real world. Okay? Great. So that's the second thing we wanted to do. And the last thing I wanted to discuss with you was about the fact that we've talked about prices of assets as being connected to interest rates and the payments concern and so on. And when we were doing that just now, I kept saying, well, the interest rate on something like this is roughly 10%. What are the things that determine what are the interest rates and, of course, therefore the prices of assets? What determines the desirability of a bond? We haven't talked about that yet, right? We didn't talk about what are the aspects of the market of assets that determine the value of these things. We discussed it on and off, but we haven't had a systematic discussion. Now, you'll remember from micro theory that whenever you talk about the market for anything, your discussion has two parts. First, you have to figure out who is it who wants these assets. The second thing, in other words, who is on the demand. And then you also need to think about who is on the supply side of these assets, who is bringing them to market, and how and what determines the demand and the supply. So to do that, let's first think about the demand and think carefully about who is it that is demanding assets. Who buys assets? Whenever I buy an asset, it means I'm paying money now for this asset, which is a promise or a contract to be paid money later. So I'm giving up money now. I'm going to get it back later. And what do we call doing that? Setting money aside for later? Of course, we call that savings. So the demand is made up of people who are saving. Now, there's another way of thinking about this person's position, because they're giving up money for someone else in exchange for that person giving them money later. So another thing that I'm doing is lending. So the demand for the assets is savers and lenders. And this may, I'm not sure if this is counterintuitive to some people. It may be the demand for assets is savers and lenders. So then what determines how much of an asset you, saver or lender, would want to buy? So one obvious fact about the Earth, about the economy, I guess, is that not everyone is involved in buying assets. Some people own, like, all the shares in the stock market and the bonds in the bond market are not owned evenly by people. Some people own a lot more of them. And the reason is just very simply because how much assets you can have is how much wealth you have in the first place. That's true at the individual level, and it's also true of the economy overall. So the total amount of assets is going to depend on just demand for assets, that is. It's going to depend on how much wealth there is. Of course, you don't buy assets for fun, although I don't know about what's going on with GameStop. Maybe some people do buy assets for fun. But anyway, in general, you don't buy assets for fun. This is an economics class. Economists certainly don't buy assets for fun. They buy them because they expect to be paid some kind of profits. And so the key determinant of asset demand is going to be what you expect the return on the asset to be. So these are very general things. The expected return may vary from one asset to another. If an asset has high expected return, then all else equal, you'd expect demand for that asset to be very high. But we were just discussing ways in which assets might differ, even if they have the same expected return, that might make some of them less desirable. Remember, we just saw an example of a bunch of bonds with different maturities where the expected return was actually the same if interest rates remained 10% forever. But long-term bonds may have had the same expected return, but the riskiness of that return, its sensitivity to changes in conditions and information, was much greater. And as a result, that made them less desirable. So riskiness of the returns is another factor that should matter for whether an asset is desirable or not. And there's one more thing we discussed that might vary across assets. Remember, we were discussing a lot last week again. We were saying money doesn't pay you any interest. The expected return is actually negative on money because of inflation. Yet we still hold it because it has a property that's very desirable in an asset, and that is high liquidity. Other assets are not as easy to use to buy stuff as money. And so liquidity is another thing that could vary across assets. So much for the demand. We're also going to want to take apart and analyze the supply of assets. And if the demand for assets is savers and lenders, then you'd think, well, that must mean that the supply of the assets is borrowers, and that would be true, of course. If I'm supplying an asset, it means I'm giving you a promise that I'm going to pay you money later. In exchange, you're giving me money now by buying the asset. So the supply of assets comes from borrowers. But as we'll see, and as you can see in the notes if you want to look ahead, there are lots of different kinds of borrowers. There are different reasons why you might want to borrow. So to get a full picture of what's the supply for borrowers, we probably need to spend some time going through that. And I think that's better to leave for next class. For now, let's be content knowing that all kinds of borrowers are in here, whether it's people like you and me borrowing with credit cards to pay off, to buy something right now, or whether it's firms borrowing in order to start up a new business or a new venture, or whether it's the government that's borrowing to, I don't know, what are governments doing by borrowing right now, to pay for COVID vaccine distribution. All of those will come in here as the supply of assets, as the borrowers. But one thing I want to say before we end, to focus on the demand where we have written out all of these things, is the following. I'm just going to draw a quick supply-demand diagram, and let's say this is for some assets. We don't know what is the supply, it doesn't matter, we'll just put in some supply curve. That's whatever the incentives of borrowers are in this market. And let's draw a demand curve, which of course slopes down because if something, why buy it? You'd buy less of something if it's more expensive. Now, suppose that this asset has some expected return. The people buying this market have some wealth. The asset has a certain amount of risk associated with it and a certain liquidity. Now, suppose that something happens that means that our view of this asset here is that it's become more risky. Now, risk is a bad thing as far as we are concerned. We don't like to have assets that are risky. So what's this going to do to my demand curve? Demand curve for this asset. Risk going up is a bad thing. So the demand for this asset should decrease. What happens? The equilibrium price for this bond should, or this asset, whatever it is, should go down. And what else I can glean from this? Remember that this is a bond. We have the following relationship between the price of the assets and the interest rate that is equivalent to it. If the price of this bond goes down, that is the same thing as saying that the interest rate must go on up, right? Because for this equation to hold, if the left-hand side goes down, the right-hand side must go down, which means this, if this is fixed, means the bottom must go up. So risk is a bad thing. When an asset gets worse in any dimension, it means its price must go down. That's just simple demand-supply intuition, which is the same thing as saying, remember this, came up last class too, that the interest rate has gone up. And then take liquidity as well. If liquidity goes down, that's a bad thing, right? We want liquid assets. If liquidity goes down, that's a bad thing. Same thing. The demand would shift left, price would drop, the interest rate would rise. So keep that in mind. Whenever anything bad happens to an asset, its price goes down because it's less desirable. And that's the same thing as saying the interest rate goes up, whether it's risk, illiquidity, or anything else. Here's another way in which assets might differ from each other. Taxes, just another off the top of my head. Taxes are, from your perspective, a bad thing, right? If your taxes on income from a particular asset go up, it makes that asset less desirable, and so you'd probably want less of it. let's solve it. So high taxes is a bad thing. Same thing, should drive down the price of the assets, which is the same thing as saying it drives up the interest rate. So keep that in mind. That intuition is going to help us a lot going forward when we look at ways in which assets might differ from each other. And as for this negative relationship between prices and interest rates, remember it's bond prices and interest rates, or asset prices and interest rates. It's just the present value formula really that's giving us that. Okay? I think that's good for today. So if you don't have any questions or comments, why don't we go over and do our end of class quiz. Let's go and see what we learned today. This is a new kind of problem. You have to move the colors into the correct order. So a blank in blank makes bond prices blank and interest rates blank. So pull each of these into the correct order, and then when you've finished, click the K button at the bottom to submit your answers. You see, you have one answer so far. So again, just drag them into what you think is the correct order, and then when you're done, press the K button at the bottom. This one takes a little longer than a usual question, just testing it out to see if it works. Let's see, one more person to answer. Thinking carefully about it. Okay, good job. And top is Lisa. Next, this is a true or false. More liquid bonds have lower interest rates. Is liquidity a good thing or a bad thing? Almost out of time. There we go. Most of you got that right. Good. Now Marshall is up top. Next. Again, here's another puzzle. Just pull things into the correct order and press the K button. Can you define the real interest rate? Blank equals blank, blank, blank. I see these take a little longer. Very good. Excellent. Now let's see who's top. Marshall is still top. He's on fire. Little typical question. Long run bonds are what? Riskier, more liquid, more solid, or safer? Okay. That was good for most of you. Marshall's still on top. Now Lisa's on fire. And last question of all. You lend me 100, I pay back 110. If inflation was 2%, what was the real interest rates? Use your definition from last question. One second left. All right, let's see how we did today. Third is Alexandra C. Good job. Second was Marshall. So who won? Lisa. Good job, Lisa. Good job, everyone else. So Lisa, What silly thing would you like to put on for the end of class?
Could you put the filter that makes you look like a female?
Do you know what it's called?
I do not.
Someone asked me about that before, but I couldn't figure it out. Let's see, this makes me an avatar female. Does that work? Yeah, I can't find the other one. I'm sorry? Does this work?
It's close enough. Yeah.
Okay, great.
Yeah.
All right then. I look much better this way. Thank you very much for finding my new look, and thanks for everyone for coming. I hope you have a great day, and I guess I'll see you in class on Wednesday. Feel free to write or call in office hours if anything comes up. All right?
Thank you, Professor.
Thank you very much, everyone. Take care.
Professor.
Take care.